For the first time in 9 months, the Fed finally cuts rates and the market cheers. Stay tuned as we dive into the repercussions.
Hi, welcome to T-Minus Retirement, the podcast where we help launch your retirement into orbit. I'm Jay Cole.
And I'm Dustin Watts.
And in today's video, we're going to talk about the Fed. They finally lowered rates, like Dustin mentioned, first time in 9 months. And it seems like they're going to continue on that path. We're kind of, a lot of economists are saying or looking at maybe another 2 additional cuts, just kind of depending on how the market is, how inflation is, and whatnot. So, but anyways, we're going to talk about just the effects of the rate cut and how the market responded to it.
Yeah, Jay, there was a lot of debate too, whether we would get 50 basis point cut, 25 basis point cut, which is what we ended up getting. And there was some outliers saying, that there would be no cut. But I think as time led up to it, and we've been doing videos about this, it was really well telegraphed. Is probably one of the most well telegraphed Fed cuts that we've seen in quite some time. And what really finally pushed them over the edge is just a little bit of that softening in the labor market.
Yeah.
And of course, that's one of the things the Fed tries to do is keep full employment. And so they really had the opportunity, I would say, to lower rates to help the labor market while still having a strong economy. I think they even revised GDP up, if I saw that correctly. But I know inflation is not really exactly where they wanted. It's closer to 3%. The Fed really wants it around 2%. But I think, in my opinion, they've really just kind of come to terms with, hey, certain parts of inflation are going to be a little bit more sticky, and they've done a ton of work getting it down from, double digits, a couple years ago, down to this 3%. So now they're kind of changing gears a little bit. And like you say, it looks like they're going to be potentially, now this isn't a for sure thing, it can always change, but potentially having a few more rate cuts, at the next 2 meetings. So, and most likely the Fed that we have right now, it's going to be pretty measured unless something kind of comes off the rails, quarter basis point at one meeting, quarter basis point at the next meeting. So that's what we're looking towards.
Yeah.
Certainly the market enjoyed that because the market just ripped higher, the days following that decision and going into it, really.
Yeah, I don't really, unless something changes or something happens, like you said, but I don't really see a 50-point basis cut or definitely anything higher than that within the next meeting or 2 meetings.
That probably would have spooked the market.
Yeah.
But, going into the decision, the more rate sensitive segments of the market have really been pricing this in. Probably the most notable area have been small cap stocks. And though, small cap stocks have just been in the doghouse for quite some time, and they're having their moment, which is great to see because getting that rotation in the market is healthy. And it's, especially when you have a small cap position in a portfolio, it's nice to get that catch up a little bit. But, this is also going to have further ramifications through other areas of the market, other areas in maybe your portfolio, and then even in your life. And I know we've talked about that a little bit, but just to kind of recap, things like money market accounts, CDs, those are coming down. It's not going from 4.5 to 0 or anything, but you've already started to see ultra short rates come down, approximately a quarter of a percent or so. And then I think really what's going to be one of the most helpful areas that we see movement is really going to be in housing. We all know that housing is really difficult right now. The Fed raising rates to where they are had its own effect on mortgage rates. I mean, mortgage rates don't track Fed funds rate, tick by tick, but the Fed funds rate coming down eventually will have some movement, I think, in a positive direction in mortgage rates, which ultimately and hopefully will free up some additional supply that is out there, because while homes aren't selling in a weekend like they were, there's very low supply. People don't want to give up their 3% mortgage. Well, if rates come down from the high 6s to 7s and they come down to 5.5 or something like that, I think that's maybe a rate where people can stomach a little bit better than where they were.
Yeah, it's we're definitely hoping for that, especially as we're
I know I am.
projecting rate cuts. Yeah, absolutely. Yeah.
So I think as we're kind of in this new cutting cycle. I consider this to be like a new the first cut of a new cycle, because I mean they cut 9 months ago and then it's been really silent since then. And the Fed's really telegraphing that they're gonna more than likely have these continued rate cuts to get to their neutral level. So we're right at the beginning of it. There is going to be effects that are going to kind of sweep through the market in different areas. I don't think it's too late, in some segments of the market to participate in those lower rates and what that kind of brings. And like I said, there's a whole host of areas in the stock market that like lower rates. Obviously, more expensive, higher growth companies like lower rates. They can borrow money cheaper. Small businesses, need lower rates because they're really affected by high rates. They're having to borrow at very high interest rates. I mean, heck, the government, they like lower rates because now, they don't have to spend as much interest when they issue new debt. So I think if we can kind of get these rates into a more neutral level, essentially, I think it's going to have some positive ramifications through many areas of the market, and we're just at the beginning of that, so we'll see how it all plays out. But it's a long time overdue, I would say.
I think a lot of economists think that the Fed neutral rate is probably around 3.5%. Could be more, could be a little bit less, but if that's the case, then that's where they're getting the projections of 2 more quarter base cuts or quarter rate cuts. Excuse me.
Well, and then we have, I'm sure we'll do videos about this as it comes out, but Jerome Powell's months are kind of limited here, right? There's going to be a new Fed chair next year, and there's a lot of speculation that is going to be somebody that is more dovish and is more open to having rates come down a little quicker. So maybe he just kind of brings it down little by little, and then we'll see what that brings. But for the time being, this is what we have. And again, so it's just a long time coming. I think everybody, realizes that, okay, rates were a little too restrictive for what's kind of taking place in the economy and the world. The rest of the world's been, bringing down rates ever since inflation really spiked after COVID. So we're a little late to that party. Luckily, the economy's held in really well during that time, and there's no, major red flags at this point. So if they can just bring them down gradually, we can get to something a little bit more palatable. It's not going to zero. So, unless something bad, really bad happens. But I think just a neutral rate, everybody can be okay with.
Right. Yeah. So this last meeting or last couple meetings, it seems like they had a huge emphasis on the labor market versus inflation. Whereas a couple of years ago, it was the complete opposite, more trying to combat inflation versus just how the labor market was. So depending on the next couple of meetings, is it going to be a 50-50 weight, or, depends on what the data comes out. If inflation's much higher than what was anticipated, then they might aim on that, or it just really depends.
Yeah. Well, I know I've talked to you, off camera about this, but it's like, I have a real, I think, challenge with the Fed trying to control the labor market with interest rates, but that's probably maybe a conversation for another day. We're the only country that does that. Well, we hope that you enjoyed this update. The market certainly has enjoyed this news that the rates are lower. We'll continue to bring content as there's updates, but we appreciate you watching the video. Please like, subscribe, and we'll see you in the next one. Take care.